Good morning, everybody. Welcome to the Flow Show. It's Tuesday, the 13th of January, and lots of moves going on in the yen. Had some fun and games overnight, some verbals, some moves, and some breaking up of levels. We'll take a look at that in more detail in a moment. Before we get started, just want to remind you that we do have a sale running on our trader funding program. You can get 30% off any of our accounts, whether that's instant funding or assessments accounts, right up until the 18th of January. I'll put the link in our Zoom chat there, or you can find it on our socials and website and so on and so forth. Use code NewYear26 to take advantage of that. January the 18th, that runs out, so this coming weekend. Right, let's go. As I said, lots of stuff going on today. Going to start off over in Japan. This brought a bit of a move in dollar yen overnight. We had notice, shall we say, that Finance Minister Katayama had a call with Bessent. Now, bit of a two-way call with this one. One of the things they were talking about is China's rare earth export controls, which has been obviously a big thing that's going on between China and Japan. But apparently they also spoke about what's going on in the yen. Now that did bring a bit of a dip overnight in yen pairs when that news got announced, but that pretty much reversed not long after. Anyway, Katayama told Bessent in the meeting about Japan's position on China's export controls. Also flagged concerns over the one-sided decline in the yen. And she said they shared worries about prolonged yen weakness and its economic impact. So this is a definite step up in the verbals, speaking directly with Bessent. No talk about whether she asked for clearance about intervention or whatever, but she certainly would have been making a case about why they would potentially intervene in markets. So the threat is still there. We're still at a very high DEFCON level. We've had verbals also from a government spokesman saying that one-sided sharp moves have been seen recently. No other upgrade on the usual comments from those guys. So, as I say, we are in intervention mode, but the market looks like it wants to try pushing the buttons. Now, when they look to intervene, that's the question everyone wants to know. I'll look at the text in a little bit, but we can never put a number on it. The last time they started intervening in 2024, we were up around 160, pretty much 160 bang on the nose. So a lot of people are touting that number as a potential trigger for the MOF to go with intervention. But as I say, they don't put a number on it. They will look at the rapidness of the moves, the size of the moves, and take it from there. But if we are springing up through 159, 160, 161, then we're going to be close to it. We do have US CPI today. They're not averse to intervening after US data points. So the risk for an intervention today is pretty high, but it's high all the way through. Something else that isn't going their way either is the overall yen index, the BOJ's yen index, or Yendex as we call it. They were on holiday yesterday, so there was no number produced. Friday's number was 74.53. Today's number was 74.09. That is well below the level where they intervened in 2024, massively below. Okay, so we are in the window. It's not just dollar yen that they'll be looking at, it's the whole yen complex. So be very careful if you're long yen pairs. But it's the usual warning, both sides. You can try and sit and run the rally, but you face the intervention risk in yen pairs, or you can try and guess when intervention will come and start shorting yen pairs, but we could still rally 200, 300, 400 pips before they think of pushing the button. So, you know, there's volatility risk on both sides of the trade for this one. Now, we were at high intervention risk coming into the Christmas period, the holiday period, and I looked at some options then. I took a couple of 2-week options, which around about broke even. I had a chance to make some money, but I was letting it run. I'm going to be looking at that again. I think options are probably the best way, safest, cheapest way to play it, because your risk is limited to your premium, and if you can grab a cheap chip. I'm looking at maybe some puts for the end of this week and maybe a week and a half, if I can get it at cheap levels. You're risking 20-30 pips on a trade, and if you catch an intervention, that's probably the best way to try and grab some money. But if you are trading yen pairs now, either side, be very careful, because you could be looking at your screen 1 minute and then it's trading 200 pips lower the next minute, or 100 pips higher another minute. And we've also had a discussion in our chat room about what might happen with intervention. In a lot of cases previously, particularly 2024, the MOF, they had the fundamentals turning on their side. We'd had rates obviously had been shooting up, and we'd seen CPI turning in the US. We'd seen the Fed maybe topping out on interest rates and starting to bring them down. So there were various fundamental reasons why the currency like dollar yen might have started to turn, and they decided to intervene as well. And some of those times it obviously marked a very significant top, which I'll show you that quickly here on the wide chart. So if you go back to when we were up at 160, this was an intervention. When we got up there, knocked it all the way down to 151s. Then we got up here, came down again, and we got interventions in this period as well. Okay, so they had the fundamentals turning, and that move, dragged it all the way down to 140s. This time things are different. Okay, yes, the Fed is potentially on a cutting path, but they haven't got much more to go in reality. It's unknown how far, how much they would cut. The economy is still doing okay. Over in the Japanese side, yes, they've got an economy that is potentially picking up. Bank of Japan's a bit more hawkish, but we know that's a slow and steady process, and the BOJ hiking once every 6 months isn't going to send yen down 20 big figures. We've also got this fiscal spending that's coming through as well. So they haven't got the fundamentals on their side. They may get it later this year if Takeichi's policies play out and it turns around the economy. Then that might lead to some sustained yen strength. That's something we've been talking about since you came on board and issued these policies. That is a risk to look out for, but it's not going to impact anything right now. So if we're trading up 160s, 161, policies are going to have nothing to do with it whatsoever. So there are some reasons why the yen might strengthen, but they're further down the line. But right now, they haven't got the fundamentals going with them. If we get a hot CPI data in the US today, that's going to add to dollar strength. Then we could see dollar yen kicking up again. So as far as intervention goes, there is a view that a lot of people are going to buy the dip purely because the fundamentals are there to say that the yen should keep on weakening. Now, that presents a problem for the Ministry of Finance. If that's the case, if they see a quick reversal of any intervention, then they're potentially likely to go again, and they may go a few times, and they may pick their moments. So if they see, if they intervene in US session, see a dip that gets brought up, back up to the levels, they may go and hit it again, maybe in the Asia session, maybe in the European session. They may get others on board, call in the ECB, call in the Fed, to hit their respective yen currencies. So this is a different kettle of fish to the intervention we saw in 2024. Okay, so just be very careful. We'll have to wait and see what happens with all that. But anyway, further news in Japan is that Takeichi has pretty much confirmed her intention to dissolve Parliament. That will start on January 23rd, and then they'll go through the motions to have an election, which is a bit of a risk that she doesn't get the support that the polls are showing and that popularity polls are showing. It's a low risk because she has been doing well over there. Conversely, if she does cement her leadership and the government, there's two trains of thought here. A, it removes any uncertainty because it strengthens the government in terms of seats and whatnot. But B, it makes it obviously all the more easier to pass her easing plans. So that would potentially see the yen weakening. That's a bit behind what we're seeing today. So anyway, that's all apparently going to happen towards the end of January. Now, one thing the election is going to do is potentially delay the nomination of a new Bank of Japan board member. The one who's going out is Noguchi. His term ends the end of March, and he's one of the bigger doves, probably the second biggest dove on the BOJ. So that could be important if, I don't know what they'll do, whether they'll keep him on or just go with an empty seat. But that could create a bit of uncertainty in that March period or around those elections. Staying on the FX front, and the head of the big business lobby, Katayama, Yoshinobu Tsutsi, if I get that right, Tsutsi, 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 says yen weakness is a bit excessive and thinks that there's a need for adjustment to stronger yen. So a bit of warning coming from the business sector as well there. You can stick that in the intervention pot. Moving over to the ECB, and here's a kiss of death from ECB's Vilroy. He says the battle against inflation has been won. The ECB shouldn't change a winning monetary policy stance. He calls the possibility of a rate hike in 2026 as a fanciful theory, barring an unlikely shock. ECB's Kocher says the ECB is not committed to any specific rate path. I do love it when you get these ECB bankers or any central bankers declaring victory, doing victory laps, because that's, as we know, is when the fundamentals tend to bite them in the arse. So let's see what happens later on this year. Sticking to the central banks, Fed's Williams, he's in hold mode. He says monetary policy is well positioned to manage the current risks. He says monetary policy is now closer to the neutral stance. He says that the Fed must lower inflation without creating undue job market risks. He says he's unable to comment on any investigations involving the Fed, but he says that eroding central bank independence causes poor economic outcomes and that markets are struggling to price uncertainty around Fed independence. White House's Hassett says the jobless rate is changing because of federal workforce cuts. He says people have been deported, are showing up in the data. He also said he does not know whether Trump approved of the Fed probe. This thing is still kicking on. Trump still denying it's anything to do with him. We do know that Bill Pulte is the man behind it. And the fact that Trump hasn't thrown his weight behind this probe, he's not talking against it, but he hasn't thrown his weight behind this probe, shows that maybe he hasn't had a huge amount to do with it, but he's still letting it happen because it's under his administration. The ramifications for this are still playing out. We've had US senators, particularly on the Republican side, Murkowski, saying that after speaking with Powell, it's clear the administration's investigation is nothing more than an attempt at coercion. He says if the DOJ believes the investigation into Powell is warranted based on project cost overruns, then Congress needs to investigate the DOJ. He agreed with Senator Tillis that it's right in blocking any Fed nominees until this is resolved. Now, one person I was waiting to hear from yesterday was Bessent, because it was as sure as the nose on your face that he wasn't going to be happy with this. Apparently, according to Axios, Bessent told Trump that the investigation creates a huge mess, and it's creating a huge mess for markets. So that might cause Trump to maybe get something going to ease back on that. The old Fed guard came out in support of Powell as well yesterday. We had Yellen, Bernanke and Greenspan coming out talking about Fed independence and the importance of it. And this morning, apparently we've had 11 central banks coming out with a joint statement supporting Powell. That leaves some 211 central banks in the world who obviously don't give a toss what's happening. But all the supposed bigwigs coming out in support of Powell there. More potential ramifications. Both S&P and Fitch rating agencies have warned that the US's ratings are at risk if the Fed independence is weakened. So that, again, is something to look at. So overall, this thing is still rumbling on the market. Well, it's done its usual thing. And I said this yesterday, if stocks close in the green after dipping at the open yesterday, then we're over this period. This set of news headlines regarding the subject. That looks to be the case. Doesn't mean it's off the table in terms of the market's eye, but, you know, goldfish thinking. There's nothing more to come from those headlines. It's now going to need something else to trigger it. I think by and large the fight back and pushback that we've seen, or that Trump will have seen, both from Bessent, from other central banks, from the ratings agency, I think it might be a case that he thinks that perhaps this is more trouble than it's worth, and maybe starts to get people to dial down on the rhetoric and pull back. The Department of Justice have also issued comments saying that this is not about interest rates. It's not about Fed independence. This is purely about cost overruns. The OMB or OBM, whatever they call it, the Office of Budget, whatever in the US, is one of the people who have kicked off about this. So they're trying to keep it to this overrun thing. And they said that they had requested information from the Fed and Powell going back months about the finances of this renovation. They hadn't got any answers, hence why they've done this action. I mean, you can believe who you want. The market and everyone else is drawing conclusions that this is Trump versus Powell. I'm not saying it's not, but things are pointing to the fact that it's not directly that. So just if the market takes that view, then again, this will wash under the bridge pretty quickly and we can go back to ignoring it. Right. In the meantime, Rick Reeder has said that the Fed has to get interest rate down to 3%. He's having an interview for the Fed job. So we're still in that mode. And still waiting for Trump to pick his man. He's still got his idea of who he wants in, but he's letting these interviews continue. Mexico's Sheinbaum had a call with Trump saying that there is clear collaboration with the US. So potentially she's been calmed. There's not going to be any military activity by Trump in Mexico. That helped the Mexico peso strengthen a tiny bit. Trump has decided he hasn't waved his tariff stick a lot this year, so he's slapping 25% tariffs on anyone trading with Iran. Now, obviously, that includes China, so it becomes another bone of contention. China has already issued comments saying they oppose unilateral sanctions and long-arm jurisdiction, so they're not happy with that at all. And just your weekly reminder that we do have the potential for another US shutdown coming on January 30th. The powers that be are scrubbing around to put forward packages and get stuff voted through. There's a bit of a timeline squeeze going on over the next couple of weeks because just the way things are, while one house is open, the other one's shut, and when one's shut, the other one's open. So being able to actually pass stuff in a speedy manner looks a bit of a struggle. We've only got 17 days to go. There is apparently a plan for the next funding package going up for a vote Wednesday night. They were voting on stuff last Thursday, which passed. I don't know the full ins and outs of it, but 17 days until the shutdown, you know what's coming. They're probably going to go to the last minute, but there is still a risk that we have yet another shutdown. So we'll have to see what's going on with that. Brand Cayman's off, as he said in the room. He's got some stuff to attend to, so he's not on the show today. Right, so that's it on the news front in terms of the major headlines anyway that are going to get us going. So now we can have a look at prices and what's going on today. Data-wise, we haven't got a huge amount except for obviously US CPI, and investing have decided to change their calendar view. So this stuff's all over the place now. Just going to have to get used to it. Right, so we've got CPI today. Now, CPI is expected to come in unchanged at 2.7% year on year. The core is expected to tick up to 2.7%. I've got no real feel for inflation. You know, November, December can be a bit of a funny time for prices. Obviously, it's a holiday period. It's a heavy sales period and whatnot. So on the retail front, at least. So that can input things. You know, even things like housing. You know, housing markets slow down at this time of year, which can impact things like prices and whatnot. So I don't have a view as to whether this is going to come in hotter or colder. But from the market's perspective, obviously, if CPI is coming down, then that increases the chances of the Fed cutting rates. So anything that is at or hotter than expected is obviously going to get the market readjusting its rate expectations. As I mentioned over the last few days, there's already been a lot of calendar shifting, shall we say. Goldie's, Citi, Morgan Stanley changing, pushing out when they think the Fed are going to cut next into the latter part of the year. Most of those banks and institutions still thinking we're going to get to maybe 3 cuts this year. But if we start getting hotter numbers this month, next month, then we're going to see expectations for total cuts coming down. Probably the market getting a little bit hawkish again. So really, if we get hot numbers today, we're probably going to see yields moving up. We're probably going to see the dollar moving up. If we get softer numbers, I think it's going to have to be significantly softer. Maybe CPI under 2.5%, core under 2.5, 2.4%. If it's softer, round expected, let's say it's a 2.6, 2.5 CPI, yeah, the market might sell a few bucks and see yields coming down a bit, but I don't think it's going to change the overall picture that CPI is still pretty sticky. So judge this number a bit like the NFP. If it's coming in around expectations, you know, we're probably going to get lesser of a move. We need to see some big variations, some big changes in the data to get the market really moving. After that, we get new home sales. This is for going back into September. I don't know if they're going to chuck out an October number alongside that as well. Still playing catch up from the shutdown and whatnot. So we'll see how that turns out. Anyway, just keep half an eye on that data. Anyway, we did have a couple of auctions yesterday that sort of went by 3-year and 10-year, went by pretty much okay. There was a bit of a dip in a take up by indirects that didn't make it overly great, but there was no real red flags from those auctions. We've got a 30-year today as well. Right, so that's it on the data front anyway. Know what to look forward to. We'll obviously be covering the CPI data live on the Face show later. Right, let's get back into it. Euro dollar, same old story really. We've seen some moves, but you know, we're not talking anything major. We had this rally since Friday. We got up to that 117 level. You know, we were showing this yesterday. It's a sticky level. We've been here before. It's a traffic area. It's been prior resistance, prior support, on and off. We topped out into there. We've had a dip all the way back. We got, you know, pretty much down to the 50s. We've had a little bounce since. We've got this intermediate line here, 1660s, that we keep sort of turning around a bit. It's a bit of an old level that goes back. It's a bit wishy-washy at the moment, but as you can see, we're just sort of trying to decide which side we want to sit on it. Do we want to sit below? Do we want to sit above? Whatever. So you can build this up into a bit of a pivot point from here. Otherwise, typically, we've had a bit of a move since last week, and give or take a few pips, we're pretty much in the middle going into US data. So that puts a risk, depending on what data we get. We either may go for a walk to the low 116s, or we go up for another test of the 117s. But you're going to need it clearing this 117.0510 area and holding at least above 117 before thinking about pushing on. Otherwise, this just might be another rally that gets sold into if we hit that and can't get through it. Cable's proving a bit more resilient, as it tends to do. Again, I don't think this is anything to do with the data, the fundamentals that are going on. The pound might just be holding up a bit better. We're still in the early part of the year. Traders coming back, putting on fresh positions. There is obviously the rate dynamic or rate divergence between the various central banks, particularly the euro, hence why the pound just might be looking a little bit better than, as I say, euro dollar. But you can see that in euro sterling, that we had this failure up here. We then failed back at the top of the zone. The top of the zone is now finding a bit of support. We've came down. We haven't tested this low as of yet. So we've seen a little bit of a step up around the 50s. It's only a small step up. And, you know, this whole thing, we're still talking 20, 30, 40 pips anyway. So we're not talking huge ranges. But we are back in the zone, sitting in the middle, doing exactly what we did here, working out which way we're going to go next. Do remind yourself of the context that we have been in a downtrend, and we are still in a downtrend, and that's confirmed by failing to break up through 85.90s. That keeps the pressure to the downside. And if we break this 84.45 level, we're probably going to go for a run down closer to the figure. 86.20s all the way down to 85.90 is a bit of an area in here that we traded through in the summer. We yet to get any decent UK data. We might get a bit of a move on Thursday when we get the GDP numbers. As I've been saying, I'm still of a mindset that there is a bit of a risk we see a bit of a pickup, particularly from the consumer, into the latter part of the year, so from November through December. However, if that risk doesn't materialise, if I'm wrong in thinking that, then we're potentially going to get bad data, and then we'll see what the pound wants to do with that, and whether this sort of move is going to find a bit of a bottom and we're getting back up into the 87s, back up towards 88s. So yeah, there's still a bit of two-way risk, I think. And I say that even as I'm still long euro sterling and still bearish on the pound. So I'm talking against my own position if the data does show signs of life in the latter part of the year. But I have to stay objective with my trading, and if that's what I feel the risk is, then I've got to look at that and be prepared for that. It's no good saying I'm short the pound and I'm going to shut my eyes to anything that happens. It is a possible risk. If it doesn't happen, happy days, because I'm on the right side of the trade anyway. Moving on, dollar CAD, and I'm keeping an eye on this one because I might have a little chop of my position, because I've been trading this one since last week and off this line here. We had a bit of a wobble last week, but we've got it back above, and we're staying above, and we're walking along it. It's doing a bit of tightrope walk, but as you can see, the bounces, you know, are pretty flimsy at the moment. So this level is going to turn into a bit of a pivot line. The longer we keep turning around it, the more you can take your cues. It's on the clock. Okay, so this one, if it's going to hold this as support, it needs to do something. Okay, it's not going to go sideways in a 10, 20 pip range for the next 6 months. Okay, it's not going to probably do that for the next 6 hours. So it's got to do something. And if it has another run up, can't get to this high or break this high, fails, you know, just shy of it, then it has the potential for seeing a pullback. Conversely, if we can't even get up to test these highs, then the only other option it's got is to come lower. Now, whether we just blip lower again like we did before, we need to find out. But if we do move under and we start to do the opposite and find resistance against this level being underneath, then it raises the risk of having a steeper pullback and a push down, maybe towards a low 138. Again, it will go on the clock. If it can't make hay, if it's back under this level, then yeah, we're potentially setting up for a wider range, perhaps to develop, maybe 138s, 139s, something like that, taking in these highs into an account. But this level, 136.50, it's a big fat red one for a reason. It's a big historical level. It's played out time and time and time again over the years. And here we are, the market doesn't know what to do with it, so it's just walking along it. It's quite surprising sometimes how levels play out like this. But as I say, for the moment, look at it as a bit of a potential pivot area. I'm going to have a little snip off my ad back if we get up to this 90 area, just because it's not doing an awful lot. Looking at some of the Antipodeans, again, another one. I've got this. I haven't moved this fib up yet because it's got a bit messy. I'm just using it. I'm lazy. I'm just using it as a trend line at the moment, as a horizontal line. We keep turning around it again. It's just becoming a bit of a pivot level, and you know, until we get a significant decision what it wants to do at this level, 67, call it 67 the figure, we're getting this turning around business. It's up, it's down, it's up, it's down, it's up and down. You want to see, you know, a reasonable amount of price action like this. If you want to be short, this is what you want to see. It doesn't mean you're going to get a good trade. You know, if you shorted here, yes, you would have had a good, decent trade. If you shorted this one, well, you might have taken a few pips out and then, you know, they had a rally up. But you want to trade it when you see a decent amount of time and the level holding. It just helps you with your conviction about a trade. Obviously, it's still relatively bullish. In respect to the fact we're going sideways a bit. I know maybe some people were looking for potential head and shoulders to set up there. Possible, I know. But, you know, if you're thinking about head and shoulders, then don't be waiting for that to play out. Look for the old, oh, let's take that off, the old magnet. You've got an opportunity here, potentially, if you haven't missed it. You know, the old 1, 2, 3 move that I like to look at. So if you're looking at potential shorts, yes, you can look if we're holding here, but if we continue to hold this 67.20, that is likely to be the trigger for a steeper move down if we don't go already off of this one. So in the short term, yeah, you might want to look at shorts, but be mindful that we're still in at least this uptrend since late November, and that's part of a bigger uptrend that we've been seeing for quite some time. So the one we've seen pretty much all through the year. So this is valid and still very much in play. Look to dollar CAD. Let's have a quick butcher's maybe at the metals and stocks. There we go. Let's see what good old gold is up to. Look at that messy chart. Right. So we've been off to new highs. Talking about its level, this is really your important level now. It's your break point off this high, 45.50. That's really where you want to be looking. Just chucking a couple of lines on as we go. So 4,600, we had the break. Well, we had resistance up here first off. We had the break, couldn't hold it, and now it's holding as resistance. So this, you know, is your key level above. 45.50 is your key level below. Probably stick a line in here just to develop the price picture. So what's that? 45, 75, 76. Finding a bit of intraday support against there. So again, you've got a bit of a tight range forming here. It's going to be too tight to move. So just watch out if you're breaking back below. You might find a bit of support coming in, you know, around 45, 60s. But we've been in this move before where we've sat in a little tight range. If we're breaking back up through 46, you want to be looking at the high. Okay, if we go and tap that high again, then maybe there's a chance of a bit of a stronger top coming into play, and maybe get a bit of a steeper pullback after that. But otherwise, same old, same old. Let the tech levels develop. We've done it all the way through this price action. You slowly build up levels. You know the levels you can perhaps rely on. If they don't work, you can pull them off. You end up with some levels that become key levels. I'm actually going to make that a white one. There you go, because it looks like a bit of a key level. So same old exercise. Draw your lines, see what works, see what doesn't, build up the picture. Then you get the levels that you want to rely on further down the line. Oil's picking up once again. I'm not going to call it a trend. Yes, it's we've had several days of positivity, but depending on what. Well, it doesn't matter what one you're looking at. We are still heavily in this downtrend. Okay, nothing really changes unless we're getting up towards the $70 mark. Even a move up to up here, 60s, 60s, 67, 68, even towards 70. Yeah, that'll be potentially bullish because that's coming off this firm support down here that we've held pretty much all through last year. So that's a bullish move, but it doesn't really change the overall picture. But that's if we do continue to rise, there's plenty of money to be made in that move there. That's another $10 you can play around in. This is your key area here for the US WTI. For Brent, if you're looking at that, various levels, this 71, 72 area has been a very, very solid support resistance point. So that's going to be your key area above in this one. But you know what they say, things always look most bearish at the bottom, and you can't deny this support that's been going on here. It has the potential for holding yet again and giving it a springboard for a move higher. Yields, got to keep an eye on those. Those US 10s still knocking around that 420 level. As always, ignore the moving averages. We don't do techs on yields. But this is... price action wise, it looks like it wants to have a bust up. It wants to have a move higher, but it still looks like it's waiting for a reason to do so. Now, if we get hot CPI today, we're trading 419.5. We might be already through 420s by the time we get to that data. If we do, we're probably going to be on for a bit of a break. And if it starts holding above that 420, then we're potentially going to be moving into this other range, which is 420, 450. And we've got yet another midpoint around the 434 area, 35. So a bit like this area here, 390s. We got that middling point at 408s, 09s. We got the same thing here. Bit of a wider range here. Now, I'm not sure whether we're going to be zooming up here. Unless the data is really hot and we start to see a trend of data hotter, or if we get more stuff going on with this power stuff, if that picks up speed and gets a bit more serious, that's going to bring further US risk off. So today for the US CPI data, a break up in yields or move up in yields is going to be dollar positive. If we get more news on the power stuff, which causes a breakup in yields, that's probably going to be dollar negative. So like I was mentioning yesterday, know your influences, okay? If yields are going up because of data, the dollar's going up because of the data. If yields are going up because everyone thinks the Fed's screwed, the dollar's going to be going down in an opposite move, US risk off, as we call it. So today, yields are correlated with the dollar, at least for the data. Dimmy, Aussie Kiwi. Yeah, I've been keeping a little bit of an eye on this one. Oh, let's go into that one. So we've had this, we have had this another half-hearted attempt on Friday to push up, get up near these highs. It's failed. It's pulled back. I mentioned that we were, tagging this 116.30s level as support. If it didn't hold, we might get a little shoved down towards the low 116s. We've had that. It's finding a little bit of support into this area here. take it down to 115.90s, perhaps. I know we've got these little tiny moves here, so if you want to drag it down to there, that's fine. But really, if we're back under 116, 115.90, we might see the air coming out a little bit more on this one. But it holding here, it still keeps the momentum going. But just keep an eye on this 35, 36 area. If we get up there and it's holding as resistance, it might indicate we're building maybe something a bit stronger up the top here, which if we do, then might mean we get a bit of a more significant downside move. It's almost similar to this, where we had a high, broke that high, then we failed, came back up. We couldn't get anywhere close to there, and you just see some moves coming down. So this is a bit tighter on the time frame, but a similar sort of pattern can play out here. You know, if we hit our head here again, then as I say, you might see a steeper pullback, might take it down through mid 115s, maybe even down to 115, low 115s itself. Of course, if we're busting up through here and we're busting up through here, then all bets are off, and we're potentially moving higher much more. Ali, everybody's saying the dollar will go down. What context do you mean everyone's saying the dollar will go down? I've been pointing out pretty much since last week, there has been an underlying dollar strengthening trend in play. I can't call it huge trend because it hasn't been massive. But, you know, I was noting with dollar yen last week, you know, we just had this building up, you know, all through the week. It's, you know, not massive. You know, it took all week to go, you know, 80, 90 pips. Obviously, we got the break and it surged on from there. But yeah, who's saying the dollar will go down and in what context? Because at the moment, it's not particularly. So whether we're waiting for something to change, the data or whatever. Okay, so talking about the DOJ stuff. As I said yesterday, and as we know with these sort of things, okay, yes, when you get these headlines coming out, it's big news. The market moves, it jumps to conclusions, it reads the slant of the headlines, you know, Fed under attack, all that sort of business. Then you go through the day and you pick up all the finer details and you look at all the different things as we've been explaining. Who is it actually Trump who's pushed this forward? It seems potentially like it's not. So you get the market reaction, which, to be fair, wasn't huge. Yeah, we got a bit of a move in the dollar. Yeah, we got a bit of move in yields, but it wasn't like a crash or anything. So you get the sensible heads coming back in and saying, well, let's look at it in detail. What does it mean? You know, as I've pointed out today, there are so many negatives for Trump if this course of action is pursued, potentially, if it remains a narrative that the Fed independence is under attack. If that narrative continues, yeah, then you're going to face a situation where investors are going to pressure yields because they're going to want more money to lend the US money. You're going to see the dollar pressured. But if it comes out that this is just purely an oversight of Fed spending, well, they're perfectly justified to do that. You know, the Fed have to answer to people as much as anyone else. And then the narrative shifts away from this is questioning Fed's independence on monetary policy, and it becomes something else. And the market goes, well, that's off the table, forget about it. And it goes back to normal. But as you know, time and time again, the market is like goldfish. It's got a goldfish memory. Okay, it will trade something for 5 minutes and then forget about it until something else happens. So yeah, as much as this might have been bad news and shocking news yesterday morning, we're sitting here now and it doesn't seem like it's so bad at the moment. Doesn't mean it can't get worse or whatever. There's a lot of overreaction. I think, you know, central banks all coming together and doing joint statements and whatnot. It sounds like it's more them against Trump than anything else that's going on, without really looking at what is actually happening with this case and what it actually means. So if you want to get sucked into the narrative, Ali, be my guest. or else you can do what we do and look at both sides of the coin and come to your own conclusions. If the markets are screaming that this is the worst things happen to the US forever, then you know that the outcome's likely to be far less than that. So don't get sucked into the hype. Do your own research, look at both sides of the coin, don't have a bias, be objective, because that's how you can then move forward with your trading. If the market's saying the dollar's going to shit in a handbasket, you know that's likely not to be the case. There's your potential trading opportunity if the market tries to trade that way. Right, I think we'll call that a day unless you guys and girls have got anything else. Yeah, exactly, Michael. He's got in 4 months, and so what's the point? What's the point in going after him now when he's gone in 4 months? And as I say, I don't know what the outcome of all this is. I don't know the reasoning behind why they want to do this, whether it's Trump, whether it's Paul T, whoever. Obviously, it's politics, but I don't know. Fred, as usual, mate, you should know by now, the ADP release a Tuesday number, a weekly number, ADP, in every week except when it's a monthly release week. So unless they've changed that, we're going to get an ADP number today. Not that it means much at all anyway. All right, quickly, Gav. Yeah, we'll have a look. I was going to look at stocks. We'll have a look at the old S&Ps, which, there you go. It had the dip yesterday and then rallied all the way back the other way into another all-time high. So this one, again, by the fucking dip, still in evidence here. It's going to take some bigger news to get markets really crap in the bed on this news. Obviously, we're going to be entering earnings week shortly, so that's going to be something the market's going to pay attention to. But yeah, can't keep a good stock market down. Right, on that front, we're going to call it a day. Thank you very much for coming to the Flow Show, sticking with me while I'm on my lonesome. Okay, we're back tomorrow. As I say, don't forget to join us on Face, where we'll be going through live coverage of the CPI data, telling you what it means, what it doesn't mean, and what the market's going to make of it. So have a great trading day, everybody. See you later. I'll see you tomorrow.